Okay, welcome back. It's our special segment, Quarter Se Quarter Tak, where we get your earnings expectations from a sector every day. And what else but IT, which is going to be kicking off the earnings season in right earnest. Reema has walked across to the wall with expectations. Reema, over to you.
Thanks so much for that. So as the December quarter earnings season kicks off for Indian IT, expectations are fairly anchored because Q3 FY26, that's the December quarter, is generally a seasonally weak quarter. There are furloughs, holiday, year-end, client shutdowns. So let's now begin with the top line, the constant currency revenue growth expectations on a quarter-on-quarter basis. For large caps, it's going to be very modest, but mid caps is actually going to be much better. So this is what the CNBC TV18 poll throws up. It will begin with TCS. That's the first one to report numbers on 12th evening. A CNBC TV18 poll throws up a top-line growth of about 0.5%. Then you've got HCL Tech also on 12, and that is going to lead with a top-line growth of nearly about 3%. And that is largely on the back of strength in its products business. For the other two, as you can see, it's a very low single-digit kind of a top-line performance. Now, mid-caps, once again, are expected to outgrow the large caps. And the two stocks that the investors are very keen on is Persistent and Coforge. And these two are likely to see about a 3.5% constant currency revenue growth. Now, at a broader level on the demand front, it's not positive, nor are there any negative surprise. The demand environment has not materially changed in the last 3 months, though JPM recently flagged off some improvement in the auto tech spends from the OEMs, which is positive for ER&D companies. But other than that, we haven't seen any sharp increase in discretionary spending. Cost takeout deals continue to dominate, and the AI discussions are active, but large monetization still remains very limited. Now moving on to the FY26 guidance. And I think the headline here is that the guidance is narrowing, but it's not upgrading. So Infosys guidance was about 2 to 3%. It could come to about 2.5 to 3%. For HCL Tech, the guidance was 3 to 4%. It could come at 4 to 5%. And both these companies are likely to maintain their margins despite the INR tailwind, on the margin front. On margins, while the rupee depreciation, the FX helps, but margins are still likely to remain structurally range-bound. So here's how the currency moved in the quarter gone by. The USD-INR pair moved from 87.3 towards the end of Q2 to 89.1. And that is about 2% quarter-on-quarter rupee depreciation. And if you look at it on a year-on-year basis, it's about a 5.5% revenue rupee depreciation. Yet, despite that, margins are still likely to remain range-bound in Q3 because some companies have wage hike, there is the furlough impact, and AI-led pricing pressure. I think the key question investors will ask and listen for is calendar year demand commentary, tech budgets. Are we finally seeing budgets improving, AI monetization clarity beyond pilots and a productivity talk, and discretionary spending recovery still remains elusive. Finally, let's put the stock price and the valuation in context. Now, the Nifty IT index did well in the October to December quarter. From 1st October to 31st December, the Nifty IT index was up 14%, outperforming the benchmark by nearly 4%. Despite this, the index is still underperforming. In the last 1 year, it's down close to about 12%, and this is the valuation. For large caps, as you can see, it's between the 20 to 24%, largely 24 times, largely within the long-term average. Mid-cap valuations are superior, but then they are growing faster in a softer demand cycle. Back to you guys.
Okay, all right. Thanks a lot, Reema, for that. Well, let's hop across to Yogesh Aggarwal, Head of Research, HSBC India, who joins us on the show. Hi, Yogesh. Good morning and good to have you on the show, Yogesh. Help us out with the top 3 points that you're looking at from these IT companies in this particular earnings season.
Nigel, look, this quarter is usually a seasonally weak quarter. And therefore, it's not going to have a significant impact on the numbers or the outlook. However, we do expect a little bit of positive commentary from the management. I think the last year, if you see the second and the third quarter results in the US were particularly positive, almost blockbuster results. But the IT spending remained weak. And there was a lot of uncertainty around macro tariffs, and customers held on to the spend also related to AI as well. We are seeing that relaxing a little bit. We may not be back to the March sentiments last year, but we are certainly closing into the March sentiments. And therefore, we do expect a little bit of positivity in the management commentaries this quarter.
Okay, so management commentary in the current quarter will be better than what it was in the prior quarter. Yogesh, hi, Reema here. So growth expectations are well anchored. We know it's going to still be an improvement in growth for this year versus last year, but not a runway growth. Maybe for large caps, it will be about 3, 4, 5%, mid caps a little bit better. But are there any stocks or pockets where you are seeing a valuation mismatch? Where one can actually, take a tactical or as an investment idea because of a mismatch in valuations?
Yeah, Reema, look, first of all, I think big picture, I don't think this sector can grow double digits on a sustainable basis. We are just too large. Just to give you a context, we think at least 1/3 of the global IT work is done through India today. Okay, so at that scale, gaining market share to grow double digit is just not possible. So we are quite linked to the global tech spend growth, which means that on a sustainable basis, larger companies probably can grow mid-single digits. And therefore, it is very tough to see a very high double-digit compounding in the stock prices as well. So where investors could see more value is smaller companies because what has happened 10 years back and now, scale is no more a significant advantage when you go bid for a larger deal. And therefore, smaller companies are getting the same place on the table as a larger one. And hence, at their scale, they can grow faster on a sustainable basis. Some of them can grow high single digits. Some of them may actually grow double digits as well over the next 3 to 5 years. And market craves for growth. So as they grow double digits, I think the stocks can compound as well. And despite the premium valuations of mid-tier, they may still compound. So I think that's where there could be a lot more value than top tier, if you're looking at from a long-term compounding perspective.
So when the IT index did well in the October to December period, we saw that relief rally, recovery, outperformance. Yes. When you spoke to investors, both domestic and foreign investors, what was their reading of that outperformance? And what is the holding now or the view?
So, Reema, last year we were overweight on the sector purely because we believe that IT growth outlook will improve this year and stocks, therefore, although at the bit of a reasonable valuations could outperform the market. In fact, this quarter in our preview report, we have downgraded the sector to more market perform inline performance this year because the stocks have run up 10 to 15% already. So I think what has happened is through the year last year, there was a realization that AI is not is negative. Obviously, in the near term, there is a deflationary impact, but not as negative as what people thought earlier in the year. And secondly, there is not more comfort around tariffs, and the corporates are a lot more comfortable to increase the spend this year on an overall transformation and overall tech spend. So both these factors led to a little bit of a better confidence for this year, and then hence the stock prices reacted to them.
Okay, thank you very much, Yogesh, for joining in. We hope you can join once we start getting the individual companies and the earnings results from them. Vikash.